Welcome, everyone. Today, we'll explore the B mechanical trading strategy, which is designed around a multi-timeframe technical approach. This means we analyze different timeframes to get a clearer, more reliable picture of market trends and opportunities. The strategy uses technical indicators to help us make informed decisions, focusing on aligning signals across these timeframes for better accuracy. An important part of the method is the ATR stop loss, which helps manage risk by setting stops based on market volatility. This approach aims to balance precision and risk management to improve trading outcomes. Let's get started and dive deeper into how this strategy works. The trading structure relies on a clear hierarchy of timeframes, starting from the 4-hour chart down to the 5-minute chart. The main trend is determined by the 1-hour timeframe, which sets the overall direction we follow. For entries, the 30-minute, 15-minute, and 5-minute charts need to align with a 1-hour trend to confirm the setup. It's important that all lower timeframes move in agreement with the 1-hour direction to validate the trade. This alignment flows logically from the 4-hour to the 1-hour and then progresses through the smaller intervals, ensuring that we avoid trading against the established higher timeframe structure. This approach helps to keep trades consistent with the bigger picture and reduces risk from conflicting signals. The core indicators we use start with the EMA set, configured at 30, 50, and 100 periods, which form a 3-line defense mechanism. These moving averages help us analyze price action, identify key support and resistance levels, and confirm the overall trend direction. Next, the Commodity Channel Index, or CCI, is set with timeframe-specific levels to align with trends and confirm the direction on the 1-hour chart, using zero thresholds to validate if the trend is above or below this midpoint for additional alignment. Lastly, the MACD histogram serves a dual role. On the 1-hour timeframe, it provides strong confirmation of the trend, while on the 15 and 30-minute and 5-minute charts, it signals momentum for entries and exits. The histogram's color changes between red and green give clear buy or sell indications, helping us finalize entry points, manage take profits, and identify continuation signals. Together, these indicators work across multiple timeframes to ensure solid confirmation before making any trading decisions. The ATR-based stop-loss system uses the average true range to set dynamic stop-loss levels based on market volatility. In this example, the ATR band is set at 2 ATR, which for gold means about a 40 pip stop-loss. This approach helps prevent false signal invalidation by only triggering a stop-loss if the candle closes beyond the stop-loss level, not just touches it. This method reduces fake-outs and keeps risk management consistent. For smaller time frames like the 5-minute entry, a 1.5 ATR setting results in a 28 pip stop loss, but the final recommendation for gold is 2 ATR for a more reliable buffer. The key is that a buy or sell signal is considered invalid only when the price clearly closes beyond the stop loss, ensuring trades aren't prematurely stopped out due to normal price fluctuations. For a sell entry, the 1-hour timeframe must show that candles are trading below the EMA, confirming the main trend direction. On the lower timeframes, 30 minutes, 15 minutes, and 5 minutes, the EMAs must all align consistently with the 1-hour trend. Additionally, the CCI on these timeframes needs to be below zero to support the bearish momentum. The MACD histogram provides the final confirmation, signaling the strength of the sell setup. All these signals across the 1-hour main trend and the 3 lower timeframes must match perfectly for a high-probability trade. This alignment of multiple timeframes and indicators ensures that the entry rules are met clearly, giving us confidence in the trade direction. The take-profit structure here is designed with 4 tiers to maximize potential gains while managing risk smartly. We start with TP1 at a 1-to-1 risk-to-reward ratio, which is a solid point to secure initial profits. As the trade progresses, TP2 and TP3 offer additional profit targets, and the final TP4 aims for a 1-to-2 or better ratio, depending on the overall trade setup. The MACD histogram plays a key role in guiding profit management. When it turns negative, that's a signal that all take-profit levels may be reached. Partial take-profits are allowed, but the rest of the position should be held until the MACD indicator shows a color change in the opposite direction. It's important not to take profits too early to let your gains run, but also to remain flexible and adjust the take-profit levels in line with the trade structure. This approach helps balance protecting profits with maximizing returns. This strategy uses a 3-line defense system based on the 30, 50, and 100 EMAs to protect positions from premature stop-outs. Each EMA acts as a defensive layer, creating multiple levels of support or resistance. The first line is the EMA 30, followed by EMA 50 as the second line, And finally EMA 100 as the third line of defense. The stop loss is always placed just beyond the slowest EMA, which is the 100 EMA in this case, ensuring the position has adequate room to avoid being stopped out too early. This setup is specifically configured for gold trading, making the strategy more robust and helping to maintain trades through typical market fluctuations without exiting prematurely. Overall, this layered approach adds a safety net by using these EMAs as hurdles price must pass before triggering the stop loss, improving the consistency of the trading system. A buy or sell signal becomes invalid if a candle touches or closes beyond the stop loss level, which is typically set at 1.5 or 2 times the ATR. When a candle hits this stop loss, it indicates that the current trend is over and you should not enter a position even if the price looks like it's at a discount. Instead, wait for a completely new and confirmed signal to ensure better risk management. It's important to use asset-specific ATR settings because each asset has different volatility and spread characteristics that affect the stop-loss placement. For example, gold uses a 2 ATR stop-loss, roughly equivalent to 40 pips, while silver requires a higher ATR range of 2.5 to 3 due to its higher fixed spread. For currency pairs like euros and GBP, different ATR and EMA rules apply to adapt to their particular market behavior. Following these signal management rules helps maintain disciplined trading and protects against unnecessary losses. To set up alerts effectively in TradingView, you want to create multiple alerts across different time frames, 5 minutes, 15 minutes, and 30 minutes, for both buy and sell signals. This multi-time frame alert setup helps you monitor your strategy signals without constantly watching the charts. When you configure these alerts, you'll receive automated notifications directly through your trading platform as soon as a signal aligns across your chosen timeframes. This way, you only need to check your charts when an alert triggers, which significantly reduces your monitoring workload. Alerts are configured to confirm that signals align with your multi-time frame criteria, ensuring you act only on the most reliable setups and can maintain discipline with your stop-loss and take-profit strategies we discussed earlier. Overall, this automated alert system streamlines your trading process while keeping you informed of key entry and exit points. The core of this strategy relies on aligning trends and indicators across multiple time frames, starting with the 1-hour trend and confirming entry points using 30, 15, and 5-minute charts for better accuracy. The main indicators we use include the 30, 50, and 100 period EMAs, along with the CCI and MACD histogram, which together help us identify strong trend movements. Our stop loss is set based on the ATR, specifically 2 ATR for gold, which helps avoid premature exits caused by normal market fluctuations. We take profit by using multiple levels, guided by the MACD histogram signals for trend continuation to maximize gains while managing risk. This approach is fully rule-based, removing emotion from trading, with clear signal invalidation rules and mechanical stops to ensure consistent decisions. Using multi-time frame alignment prevents trading against the trend, and the ATR-based stop-loss takes subjectivity out of position management. Applying these rules consistently promotes disciplined, repeatable trading that focuses on staying in the trend and managing risk effectively.